Everyone's obsessed with inflation right now. Morning news, coffee shop chatter, finance Twitter. It all points the same direction. Prices up, rates up, your wallet thinner. But that's not the biggest risk to the American economy right now. There's one number, one market, one mechanism that's far bigger, far more fragile, and almost never makes the headlines, not because it doesn't matter. Because it's too complicated to fit in a 2-second clickbait title. Today, we're taking it apart. Okay, let's back up for a second. For more than a decade after the 2008 crisis, regulators made one big decision: make the big banks safer. Thicker capital cushions, tighter rules, tougher oversight. Sounds good, right? A stronger system. But in finance, money never actually stops moving. Close one door, it finds another. And that other door is called private credit, a massive corporate lending market that operates outside banks, outside regulators' radar, outside the media spotlight. According to the Financial Stability Board's May 2026 report, this market is now estimated at somewhere between $1.5 trillion and $2 trillion, and even that's a figure the FSB itself admits is rough, because there's still no standardized definition across regulators for what actually counts as private credit, $1.5 to $2 trillion. Flowing into companies that the big banks themselves consider too risky to lend to directly off their own balance sheets. So how does it actually work? Let's use an analogy to keep it simple. Meet Andy. Andy runs a mid-sized company, not a unicorn startup, not a giant corporation either. He needs a loan to expand. Used to be, Andy would walk into a bank. The bank checks his financials, sets a rate. Done. And that loan sits under strict banking regulation the whole time. Now, Andy goes to a private credit firm instead. Not a bank. This firm pools money from pension funds, insurers, institutional investors, and channels it straight to Andy, at a higher rate, but with far looser oversight. On paper, this looks like an elegant solution. Andy gets his money. Investors get better returns than a bank deposit. Everybody's happy. But here's the part almost nobody talks about. Because these loans aren't traded on an open market, their value isn't set by the market, it's set by the very firm that made the loan. And those big banks that are supposedly safe now, they never fully left the game. According to analysis citing Federal Reserve data, the 6 largest U.S. banks now have roughly $300 to $322 billion in committed lending to private credit and private equity firms, up sharply from around $10 billion in 2013. Banks aren't lending directly to Andy anymore, but they're lending to the people who lend to Andy. The risk didn't disappear, it just moved one layer deeper. Say that again. The people making the loan are also the people grading how healthy that loan is. The bond market is like the adult in the room. It tells you immediately when something's wrong. Through prices that move in real time. Private credit, that room is dark. Nobody knows something's wrong until someone flips the light on. Let's look at a concrete case so this doesn't stay abstract. And this isn't hypothetical. This happened in the last few months. February 2026. Blue Owl Capital, one of the biggest names in private credit, scrapped a planned merger. That single event triggered a wave of panicked withdrawals from investors. And it wasn't just small players caught in the fallout. CalPERS, the largest public pension fund in America, got caught up in it, alongside pension systems from Ontario and British Columbia. The Fed itself, in its May 2026 Financial Stability Report, acknowledged that outflows from private credit funds have exceeded inflows since the first quarter of this year, even while still calling the risk limited and manageable. But here's the part that's actually wild. If you look at headline default rates in private credit, they look calm, around 1 to 2%, based on the Morningstar LSTA index, which only counts formal, officially documented defaults. Fitch Ratings uses a broader methodology, one that also captures quiet restructurings that never get labeled a formal default. The result? The real default rate hit 5.8% for the 12 months through January 2026, the highest level since Fitch started tracking this number. That's not a small gap. That's the gap between the story the market wants to believe and what's actually happening inside lenders' internal valuations. And here's what makes this more than just rich people playing with their own money. Private credit is now making its way into ordinary workers for 101k accounts through partnerships with Fidelity and Vanguard, backed by new Department of Labor guidance. which means risk that used to sit exclusively with big institutions is now quietly spreading into everyday retirement savings. Speaking of values you can't fully trust, that's exactly why it matters to have a way to check your own financial health honestly, not just glance at the surface-level numbers. Okay, back to the topic. This isn't just about one type of corporate loan. This is a bigger question. Every time regulators close one loophole, the money doesn't vanish. It moves to wherever isn't regulated yet. 2008 was about subprime mortgages. Now the shape is different, but the logic is the same. Risk that used to sit inside banks is now scattered across your pension fund, your parents' insurance policy, institutional portfolios that were supposedly safe. And because private credit isn't traded on an open market, there's no early warning system, no red chart you can check every day. You only find out there's a problem when a big institution suddenly announces losses that had been quietly building for years. Follow the incentive. Who benefits from a system this opaque? Private credit firms collect huge fees managing this money. Institutional investors get higher returns to show off in annual performance reports. Everyone directly involved has an incentive to keep the everything's fine story going for as long as possible. And this isn't a small allocation. Alternative assets, dominated by private equity and private credit, now make up nearly a third of total U.S. public pension fund assets. Some major pension funds are already overweight by billions of dollars relative to their own targets. Who has zero incentive to keep that story alive? You, the person watching this video. This is also the answer to why this topic never goes viral. Inflation news is easy to sell. Everyone feels directly every time they check out at the grocery store. The chart is simple. The story lands in 5 seconds. Private credit. It needs context. It needs analogies. It takes time to explain. There's no dramatic photo for the news thumbnail. No number people can feel instantly at the register. Major financial media also tend to have close business ties with the institutions playing in this market. So don't expect them to be the first ones shouting "watch out" at full volume. That doesn't mean it's a deliberate cover-up. It's just that media incentive structures aren't built to prioritize a complicated, slow-building story, even when the eventual impact could dwarf this month's inflation headline. So, back to where we started. The biggest risk to the American economy isn't the inflation you see every day at the checkout counter. It's sitting in a trillion-dollar market operating outside the spotlight, valued by parties who had every incentive to make it look fine. I'm not a financial advisor, and I'm not going to tell you what to do with your money. But if there's one takeaway from this video, never trust a single narrative just because it's the easiest one to understand. Check the data behind the headline. Ask who benefits. If this video made you think twice about what's actually happening behind the scenes of our economy, subscribe, because there's a lot more stuff the media won't tell you that we're going to keep unpacking, one at a time. And drop your take in the comments. Who do you think gets hit first if private credit really starts to crack? See you in the next one.